Good afternoon, and welcome to today's iSectors webcast featuring a precious metals discussion with Aberdeen Standard Investments. Before we begin, I wanted to cover a few housekeeping items. You will be in listen-only mode throughout the webcast, and there will be a question and answer session towards the end. You can submit any questions you have throughout the presentation directly through the Bright Talk interface. With that, let me turn over the webcast to your host, Chuck Self, Chief Investment Officer for iSectors.
Thank you very much, Adam. Good afternoon, everyone. As Adam indicated, I am Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today as we discuss how to truly diversify client portfolios with gold and other precious metals. We are honored to have with us today Stephen Dunn, Head of Exchange Traded Funds, and Stan Kiang, Director of Exchange Traded Funds for Aberdeen Standard Investments. How are you gentlemen today?
Great, Chuck. Thanks for having us.
Yeah, thank you for being with us. Steve guides Aberdeen's strategic direction and distribution strategy for ETF. He has been with Aberdeen for 5 years and is a veteran of Deutsche Wealth, BlackRock iShares, and Vanguard. Stan leads Aberdeen's ETF distribution nationwide. He also has been with Aberdeen for 5 years and had previous positions at BlackRock iShares, JP Morgan, and Bank of America. Steve and Stan will spend 30 minutes on an overview of the gold market. I will then utilize 10 minutes discussing our recommended solutions to increase diversification in client portfolios with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box on the right side of your screen. This presentation will be recorded, and a copy will be available on our website tomorrow at www.isectors.com. Just click on Editorial and Media at the top of the home page, then iSectors Magazine, and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees after this call. The iSectors view is that advisors have not focused enough on risk management in client portfolios. Having been through 10 years of a great equity market and then a significant decline, you may have struggled to keep up with your benchmarks. Also, many of our clients created their wealth from a single activity. We at iSectors believe that protecting principal is going to be the investment focus of advisors and clients over the next 5 years. The forward-looking advisor will begin to review asset class allocations and increase diversification in client portfolios. A number of researchers have come to the conclusion that a 15% allocation to alternatives is all you need to properly diversify accounts. So instead of a 60% stock, 40% bond allocation, a 50% stock, 35% bond, and 15% liquid alternatives weighting scheme will be more effective at protecting principal. This is even more important at this time since interest rates are at historical lows with not much more room to decline. If we enter into a secular rising interest rate environment, that could hurt bond returns. Clients with liquid alternative exposures not correlated to equities and bonds will be protected. I will now hand the presentation over to Steve and Stan.
Thanks, Chuck. This is Steve Dunn, and I'm going to take you a little bit through and bring Stan into the conversation on certain portions. But, you know, it's amazing, Chuck. I think you and I spent some time together in late January down in South Florida at the ETF conference, and I spent a lot of my time while I was down there having different conversations, different press opportunities, things along those lines. And the single biggest question that I got asked while I was down there was sort of the role of gold in the portfolio. And if we remember correctly, 2019 really strong equity market, and what I was trying to reinforce to advisors during that time frame was, hey, equity markets feel pretty lofty at this point in time, and there's going to be a need to diversify portfolios. I certainly didn't expect to see what we've seen over the last couple months, but I think that story has been reinforced, and certainly, Chuck, the way that you've articulated in the lead up of this conversation is perfect. So I think so I think from that standpoint, the challenge from an asset allocator's standpoint is when you have typical market sell-offs, right? The challenge, what we've seen increasingly in these market sell-offs is all assets become highly correlated. And so even though you think that you've done a pretty good job in allocating across different portfolios, the challenges in these market sell-offs, you basically have everything start to correlate together. So therefore, your entire market portfolio, reacts the same way. And as I was having conversations with reporters, that was the message I was trying to get to them. I don't know exactly what the stimulus is going to be, but the reality is we're going to need something in the portfolio to diversify. And like I said, little did I know about what we were going to see sort of through Q1 and certainly into Q2. So if you look at the slide that's presented here, you see the correlation between gold and other major asset classes. And what we try to do by looking at this particular slide is not only its low correlation versus things like on the S&P 500 or the Bloomberg ag product or anything along those lines, but what you also see is gold has low correlations versus other alternative asset classes. So whether that's hedge funds or whether that is real estate or anything along those lines, the beauty of gold within a portfolio, as we'll talk throughout the presentation, is gold has a low correlation to other asset classes, which is exactly what you want in a portfolio when things start to go high correlation or start to correlate to each other. And so from that standpoint, we've seen that through this recent market downturn, as we'll talk through. As I've been talking to different folks over the last 10 weeks about gold, my general response is gold has done exactly as you would have expected and very consistent with the way that it's behaved in other types of marketplaces. And so I think this, so whether you call it a safe haven trade or whether you look at a low correlation, ideally there's been more conversations within the last 10 weeks specifically around gold and the role that it plays in its portfolio, because once again, it actually did exactly what you would have wanted it to do from a portfolio standpoint, which is good news. And so, we have a couple charts that will show, and so whether you look at 2001, 2002, whether you look at 2008, 2009, or 2012, or once again in 2020, you continue to see some of these patterns that exist. While the stimulus always might be a little bit different, the reality is the pattern that you see and the way that gold has responded to this is very consistent from that standpoint. That's reassuring to not only investors but allocators specifically to gold. So if we actually go to the next slide, and I'll introduce my colleague Stan, who will jump into the next slide. So Stan, do you want to take it from here?
Sure. So good afternoon, everybody. Actually, before I speak to this slide that's showing here, I just want to make one last comment on the prior slide, in that, clearly the point is to just understand that gold and precious metals have a different sort of correlation pattern to other asset classes. And we'll be talking a lot about gold in this presentation, but really, when we're speaking about the correlation of gold to other asset classes, or we're showing the pattern of returns of gold to other asset classes, the same would hold true for other precious metals as well. So I think that although we're talking a lot about gold, all of the themes apply to precious metals more generally. So I just wanted to put that out there. For this slide, what we're looking at is gold's performance versus the S&P in the Barclays Ag since 2000. And clearly you can see that gold has had quite a run. And really the 2 points that I wanted to make on this slide were, first off, that there's many investors that believe that gold doesn't have a role in the portfolio. One, because they don't understand the correlation aspect of gold, but two, because they just haven't taken a close enough look at sort of how gold has performed versus other asset classes. So the mere fact that you're looking at that blue line, which represents gold, and the price of gold's rise since 1999, so over the past 20 years, it's absolutely not true that gold has not had any kind of return. In fact, there is quite a bit of return there, as the price of gold in '99 was around $300 or just less than that. and we're currently hovering around $1,700 per ounce. But more importantly, as Steve indicated earlier, is you look at the different lines. So the blue line being gold, the gray line being the S&P 500, and then the darker line being the Barclays aggregate. You'll notice that there's a very different sort of pattern of returns, and particularly when you hone in on any specific periods where there were market events or market volatility. Take, for example, the 2007-2008 time frame, the 2011 time frame, or even just the very end of this line chart. You can see there's a divergence in the way that things are performing, and that's really what you're after when it comes to creating a diversified portfolio. Is you want that pattern of returns to differ amongst the various holdings. Moving on to the next slide, I think this just sort of highlights how this pattern of return kind of manifests itself in your portfolio. And what this slide is showing is really 6 of the past major market events that we've seen, a downdraft in equities. And in this slide, what you're looking at is the dark blue line represents gold. I guess the teal blue line represents global equities, and then the gray line represents U.S. equities. And you'll notice in each one of these events, you'll notice that gold has actually done the exact opposite as these equities performed. But it's important to note that gold's correlation is low to equities and to fixed income. It's not negative. So you're not always going to get this inverse relationship. But what this slide really highlights is that insurance aspect, and that when you have a properly diversified portfolio, you can get that smoothing effect from from these non-correlated assets. Obviously, this slide is showing the last 6 events. So the 07 Chinese bubble, the 08 financial crisis, the credit downgrade was 2011, the devaluation was 2015. Brexit was 2016. Obviously, we had the pullback in 2018, and now the COVID-19 pandemic here in 2020. For this latest market event with COVID, we don't have the bar chart showing, but the results would look very similar in that gold is up around 17%, while the other equities around the world are down substantially, in most cases greater than 10%. But Steve, why don't you tell us a little bit about sort of how things have done year to date? Oops, Steve might be on mute, so I'll just speak for him.
Sorry about that, Stan. Sorry about that. And so as Stan had indicated during the last slide, you can see the results in 2020, and they're very consistent with what we've seen in prior situations. And so, and as Stan indicated, it's not necessarily that you always get a negative correlation in gold; you get a low correlation. And we did receive in some of the early in some of the early downturn in the market where you actually had gold sell off. We actually had a lot of investors that contacted us and say, "Hey, what's going on with gold?" And so it's sort of the good and the bad with gold, and we'll talk a little bit about that and then get a little bit deeper into the slide. Part of the reason gold did initially sell off as the market downturned, but it sold off for different reasons. One of the things that you find with gold is highly liquid. People actually like gold because of its liquidity characteristics. And what you found was equity investors sold off their gold rather than selling off their equities in order to meet margin calls. And so that put pressure on gold initially. But once the investors understood the nature of what was going on with COVID-19 and its potential impacts, you instantly saw gold start to rally back as a response, as a safe haven option for investors. And that was pretty consistent with what you actually saw in other market downdrafts. So in some situations, you do see that where gold is actually used as a liquidity vehicle more so than anything else. But if you go to the slide, what you tend to see, or what you're seeing with gold, is sort of a lack of volatility associated with gold during this time frame. And so as you can see, the other asset classes that have taken place and the spike in volatility associated with any of those asset classes that you're looking, so whether you're looking at global assets, or whether you're looking at U.S.-based assets, small cap or large cap, or anything along those lines, the equity markets for the most part responded the same way, which they increase the volatility associated with any single portfolio from that standpoint. And so if you're ideally looking to add something to a portfolio to offset, as Chuck and his team do, right, you're looking for things that potentially could dampen volatility associated with that. And once again, I sort of hark back to the statement that I keep providing to reporters is gold has done exactly as you would have expected from that standpoint. It has dampened the volatility in a period where you've had a high level of volatility from that standpoint, no matter which of the asset classes that you're looking for. And so that's the true sense, that's the true call of a diversifier, is to be able to do that aspect. If we take a look at the, I'm going to forward to the next slide. Sorry. If we take a look at the portfolio allocation scenarios, what we've tried to do with this particular scenario is, so if you take the traditional 60-40 portfolio, and there's been lots of stuff that's been written about this traditional 60-40 portfolio. Does it work? Does it still work? Does it have the same characteristics that it always has? And does it provide what investors need through periods of times along these lines? And so basically you have two lines there, the dark blue being a traditional 60-40 portfolio, the lighter blue being ideally that 60-40 portfolio, but with a 10% allocation to gold. And so ideally it would take 5% allocation from equities as well as fixed income. And what you see is ideally what you would expect to see, right, is you get a little bit of downside protection from that standpoint, but also if you sort of exploit it out, or you look at other types of metrics and things along those lines, what you would ideally see is lower volatility, an increased return in most types of situations from that standpoint. So it's one of these things that Stan and I keep harping on, is this aspect of the role that gold plays in a portfolio. And a lot of times, there are certain situations where you may not know exactly what it is until you actually need it. And these are the types of scenarios where something like gold really stands on its own as part of an overall portfolio, or part of a well-diversified portfolio. So from that standpoint, it gives, if you're an asset allocator or if you're an advisor, it allows you to manage that client expectation through these periods of time from a volatility perspective, because it mitigates some of those types of aspects, and it mitigates some of the risks that are typically associated from that standpoint. So this just takes a look on that standard 60-40 portfolio. What happens if you add a little bit of gold in the portfolio? And obviously, we're supporters of gold from a product standpoint, but traditionally when clients ask us, what is the right percentage of allocation from a gold perspective or from precious metals in a portfolio? And our answer is it depends, obviously, as you would imagine, on a host of different things. But the allocation should never be zero. Only from a standpoint as it has these characteristics that are very unique to this asset class that provide very interesting components to a well-constructed portfolio, and they continue to show themselves time after time from that perspective. So Stan, do you want to talk about the next slide?
Sure. So what we're looking at here is it's just really, we're going to take a second to just differentiate investing in gold or precious metals bullion versus gold miners. I think this is an area where some people may be confused, and I think that there's a lot out there, a lot of folks out there that believe that they're getting the same thing. When they're buying, for example, a gold miner ETF or a gold mining stock like a Barrick Gold, for example, versus owning hard bullion either through an ETF or holding bars or coins themselves. It's true that both will have, in the case of a golder versus a gold miner, it's true that both will have a high correlation to each other. And obviously a gold mining stock is going to hold stocks of gold producers. And of course, naturally, those businesses are going to be highly correlated with the price of gold. In many cases, I guess, gold miners, I suppose, could be beneficial from a return standpoint, given the fact that naturally those types of businesses have a lot of leverage built in, right? They borrow money to drill these mines and to hire people, and the results are going to be slightly levered to that extent as well. But really, that's where the similarities end between physical gold bullion and gold miners, in that when you're owning a gold or a precious metals bullion-based ETF, or holding bars or coins for that matter, you're actually holding, you're getting the price return of the metal itself, and that's it. There's really nothing else to add or detract from that, aside from any commissions you need to pay to get in and out of hard bullion for that example. But with stocks, you're actually owning businesses, as you know, and each one of those businesses is going to have different drivers to their price returns, from profitability, cost structure, management, and other sort of idiosyncratic type risks that you would have to factor into your investment in a miner's or a stock or a company that's producing these commodities. So I think I'm dating myself to some extent here, but I always like to use the example of the Exxon Valdez oil spill, which happened back in 1989, if anybody can remember that. And obviously, there was a lot of fallout from that event. And so, I'm pretty sure that folks that invested money in Exxon, for example, wanted to get exposure to the oil and gas market, wanted to get exposure to that commodity, but what they ended up getting was a ton of idiosyncratic risk from that unfortunate event. But those are that's something that we run into quite a bit, is people asking about owning miners versus bullion, and I think there are clear and distinct differences there.
Hey Stan, this is Steve, and just even a more recent note. So, obviously we are all living the impact of COVID-19, and COVID-19 obviously had a very big role in sort of some of the things that were going on specifically in this market. Obviously, gold has responded very well to some of the uncertainty in the marketplaces, but COVID-19 also had the impact of shutting down mining operations in places like Central South America and South Africa and things along those lines. So you've seen where a gold and a gold mining stock reacted very differently to what was going on. So South Africa shut down mining production for 21 days. That had a huge impact on those individual mining companies. That was outside of anything that was taking place specifically in the gold market. And so, as Stan indicated, you can end up with very different stimulus, very different drivers of equity performance versus what's going on in the underlying gold market. And so that's why we always suggest that while you can look at gold and gold mining through sort of the same lens, they're not very good substitutes for each other, because they absolutely do very different things and provide you different set of risks associated.
Yeah, that's a great point, and I think that the one main point that I probably neglected to mention is that we're talking about gold and precious metals as a diversifier here, and one distinct issue with owning gold miners is that they're highly correlated to the equity markets. So if you're going to get a downdraft in equities, you're obviously going to get a downdraft in gold miners as well. So that protective element that you're investing in, or that you're trying to expose your portfolios to, won't hold true when holding miners. So it's just something to keep in mind. But as it relates to the price of gold and precious metals, for that matter, there are a lot of factors that are sort of working in the favor of precious metals right now, and I think we've seen obviously a lot of that be reflected in the price of gold. It's been on a bit of a steady climb, but why is that happening? Well, it's really because there's kind of a perfect storm of events that's really brewing right now, and I think underlying that storm are a lot of the things that are creating, you know, tremendous volatility in the equity markets and probably creating a lot of nervousness amongst investors and yourselves, for that matter. But really, you know, we've always spoken to precious metals and gold as a strategic investment. You know, as Steve indicated before, you know, it's going to depend on your portfolio composition as to how much precious metals you should have in your portfolio, but the fact of the matter is it should probably never be zero. And the reason is math has shown and history has shown that it can provide that diversifying effect from a strategic standpoint. But by the same token, and this isn't really the reason why, you know, we like to think about gold and precious metals in a portfolio, but there are so many tactical reasons to look at it right now as it relates to that perfect storm that I talked about, and I think this slide highlights quite a few of those items that are creating this storm. And obviously, the continued economic slowdown. I mean, I think, you know, last I saw today, Q2 GDP was supposed to be down, you know, 30%, and that's unprecedented. And regardless, in my mind, regardless of, you know, whether we can reopen the economy today or whether we can reopen it next week. The fact of the matter is the damage is done. A lot of unemployment's obviously hitting record levels. You know, production and GDP is clearly on the skids, and you know, public companies are not even able to give guidance at this point. So I think this economic slowdown, despite, you know, what we're seeing in the equity markets, like yesterday, it was up 4%. I just think a lot of the pain is yet to be felt, and we're going to continue to feel that looking forward. From an interest rate standpoint, we've heard it from Mnuchin and the rest of the federal government that interest rates are going to be low, if not negative, going forward. I think the negative rate talk is certainly Chairman Powell he's not buying into that right now, but he's committed to using any weapon that he has to fight this slowdown that's now in front of us. And so I certainly don't think rising rates is going to be anywhere in our near future. That low interest rates and certainly negative rates are going to hurt the dollar, and so that's usually beneficial to hold something that can be a store of value like precious metals. Substantial unemployment, we talked about that. It's going to hit record levels. I don't think I put the term possible recession in there. I think that's a foregone conclusion. It's probably already happening. And then the deflation aspect. I think it's interesting because given all the money that's being printed, you know, one would expect that all of that's going to be inflationary. But I think right now what you're seeing in the marketplace is very much a tug of war, where clearly there's going to be some money put to work, and those asset flows are going to drive prices of certain things, including commodities going forward. But I think right now there's been so much demand destruction that I think that we're kind of in a bit of a phase of deflation, and that sort of has its own risks and impacts as it relates to, you know, how that impacts the overall economy as well. So bottom line, you know, we could continue to go down and add more things to this list, but I think the market can best be summarized by just there's a lot of chaos right now and uncertainty, and usually in environments where we have a lot of uncertainty, gold and precious metals tends to do pretty well. Steve, anything you want to add to that?
No, I think that's exactly it. I mean, I think we've started, and actually, I think I see one of the questions that come in, and we're just now actually starting to touch on that topic a little bit more, where reporters and investors are asking us, well, you know, we always hear about gold in sort of these inflationary regimes, and we know that, and it makes sense that gold does well during those time frames, but what about in deflation, you know, kind of components? And so it's a little bit of a challenge, right, because there's only a handful of times in which you can sort of point to where there has been sort of this extended period of deflation, you know, from that standpoint. And so I think while it may not be as strong and it may not be as as researched as potentially some of the other options. I think the reality is during periods of deflation, investors are going to increase their allocation to gold as a hedge. They're concerned about things like financial counterparty risk. They're concerned about private and public sector defaults, layouts, bankruptcies, things along those lines. And so that case for the safe haven that gold presents may actually still ring true, right? And so, like I said, there's just not as many scenarios that we've seen for a host of different reasons of sort of gold's role in the government and things along those lines over the last years. But we are starting to see that questioning come in more and more as deflation looks like an option versus what we've seen in other situations where it's inflationary. Yes, we would expect the amount of the massive amount of stimulus that's out there for that to be inflationary, but it may take some time before that sort of grips in with all the other pain that has been suggested by Stan. But it's a great point and one that we actually have been getting more and more questions on.
Yeah, thanks, Steve. And to to the viewer that asked the question, it's a great question. I think the question for those of you who are listening, he was just asking about how precious metals act during periods of deflation, and obviously stores of value are most intuitively bought or invested in during periods of inflation. But I think the point that that was made earlier, and just that when you have deflation, you end up getting basically economic crisis with layoffs and defaults and things of that nature. And so gold ends up being sort of a go-to tool for that type of market regime as well. At this point, I'll hand the microphone back to Chuck. Chuck, maybe it's time to just kind of remind everyone what how you guys think about all of this, and how you guys use gold bullion and other precious metals to put your sort of thesis to work.
Well, thank you, Steve and Stan, for that thorough overview. As you can see, Aberdeen has a lot of intelligence on the precious metals markets. At iSectors, we use the Aberdeen precious metal bullion strategies in our portfolios where they're needed. But before we get to that, I just want to reiterate what I said before, is that we have to address the concern that people are not diversified well enough, and that too many people are focused on returns, whereas the most important thing is to focus on risk. We can't manage returns. We can only manage risk. And I think this event, especially if you had a bond portfolio that had a large amount of credits, shows that bonds alone cannot diversify the portfolio fully. And the next logical thing to do is to own portfolios that are all of or much of precious metals. So a great place to start with the iSector solutions is the iSector precious metal strategy. Let's see if I got that right. Yeah, the iSector's precious metal strategy. The precious metal allocation has had the best results for the first quarter of this year and over the past 12 months of all 21 iSector allocations. And in fact, we found out yesterday from Informa, who is a large database, that this allocation was in the top 5 of global balanced models over the past 3 years, that ETF models that are used. And so historically, precious metals has been one of the most uncorrelated asset classes with stocks and bonds, like Stan and Steve indicated. The precious metal allocation is available to offer advisors a simple and cost-efficient approach to acquire and diversify portfolio of precious metals bullion. This allocation model invests in exchange-traded funds, such as those managed by Aberdeen Standard, that hold portfolios of gold, silver, platinum, and palladium bullion. The precious metal allocation provides for ease of purchase and sale of the investment. It eliminates most of the costs of holding bullion and increases liquidity when compared to directly acquiring and holding physical precious metals bullion. A more diversified way to play this is the iSector inflation protection allocation. This model includes inflation protection bonds, precious metals from Aberdeen, commodity ETFs also from Aberdeen, and other real asset-based ETFs, ETNs, master limited partnerships, and mutual funds. And this strategy is intended to provide investors first with the hedge against inflation, which may or may not come back. We don't know, but that's the whole point of having diversification, is be ready for anything that happens. But also, even in deflationary times, this model has a low correlation to equities, and that makes it a great diversifying allocation. The bottom line is that even a 5% to 10% inflation protection and or precious metals allocation to start or bolster a client's diversification effort is worthwhile. And our advisors and their clients that are already holding these allocations are receiving some protection from the equity market, and they will continue to receive protection if we have a decline ahead of us. I will turn this over to Adam.
Great. It's now time for the question and answer session. As a reminder, if you'd like to submit a question, you can do so directly through the Bright Talk interface. And thank you to those who have already submitted a few questions. So we'll get started. Chuck, this is for you. Does iSectors, we've mentioned that you hold bullion in your models. Does iSectors only hold bullion, or do you also hold miners as part of the allocation?
In the precious metals allocation, it's purely bullion for the reasons that Stan indicated in his slide, in that this is a strategy that needs to be completely as low correlated to the equity markets as possible. And so we only own bullion for the four precious metals in that strategy. In inflation protection, we have both bullion and the miners in order to, again, increase the differentiation and diversification of the portfolio. But probably the other place that is important is that in our iSectors post-NPT allocation strategies, we have gold miners in there too. So there's different times and different uses for gold miners versus gold bullion, but for the greatest diversification efforts, gold bullion, gold, silver, platinum, or palladium bullion funds are the best to include in client portfolios.
Great. Our next question. With Aberdeen Standard Investments gold ETFs being physically backed, how do you store that much gold?
Yeah, Adam, this is Steve, and I'll take that question, and Stan, feel free to jump in. And so I think, our gold product, S-Gold, works very much in the same fashion that many of the other gold ETFs work. So we have partners that we work with, and in our case, it happens to be JP Morgan, who we work with, based out of London, and so they have vault locations in London, and so we work directly with them, and they provide sort of vaulting services for us. There's a handful of firms that play that role globally. JP Morgan happens to be one of the leaders, but there's others, HSBC or ICBC, and some of these other types of firms. And so they provide the security associated with the location associated with the vault and things along those lines. Some of the unique things that we have as part of our relationship and that we've built into our product We actually conduct 2 audits per year. One of them is scheduled, one of them is unscheduled, as unscheduled as it can be. And so we go into the vault location twice a year, make sure that they're audited. And so, and that audit is done by a third party, so it's not being audited necessarily by Aberdeen Standard. And that company goes in and they literally weigh every single bar that is in our, in the Aberdeen Standard Trust. So they're looking for purity, they're looking for weight, they're looking for all those types of aspects that you would that are commonly held with that particular bar. And so it's a fairly painstaking type of situation and scenario, but they literally are verifying every serial number on every gold bar, you know, from that standpoint, and that process is done twice a year. We list every bar of gold that is in our trust on our website, and so that you can verify serial numbers and those types of components. And so from that standpoint, it's a pretty interesting process, but nonetheless, for these types of firms, it's sort of business as usual because this is what they operate in, this is how they operate from that standpoint. And so typically, one of our employees from Aberdeen Standard participates in one of those audits each year. And so, you know, if anyone has any question, or even if your investors have questions about it, we'd be more than happy to provide, you know, details as it relates to that process. But in our particular scenario, JP Morgan is our main provider and who we work with in the storage component.
You know, I'll just make one more comment on that. And I think a lot of the questions tend to arise around, you know, the storage and whether the gold is all really there, and all, you know, those types of questions come up generally because of there's one particular fund out there, it's a competitive fund, that is the biggest in the world. That particular fund has $60 billion in that fund. And so, you know, when people ask the question around, you know, is all the gold there? I'd like to say that it is, but the bottom line is there is no vault that can hold $60 billion of bullion. So what ends up happening in that case is the vault is spread out not only from the inside the primary vault that they use, but there's going to be a good number of sub-custodians that they're going to have to use as well in order to hold all that bullion. And the challenge comes with, you know, with that auditing process that Steve mentioned, where, you know, that if you're the 10th sub-custodian down the line, who's looking at that, or is anybody looking at that? And I think that's where a lot of the questions arise. Again, I'm not here to say that that metal isn't audited, but that when you're sort of down the line in the custodial list, that responsibility no longer falls on the fund company. It falls on the primary custodian. So in our case, for better or for worse, probably better for you as investors and worse for us as the fund provider, none of our funds are nearly that large. So all of the bullion that we hold, whether it's in our gold or whether it's in any of our other precious metals funds, they reside, that bullion resides in the vault of our primary custodian. And as Steve had indicated, we inventory all of that bullion on a daily basis. Each bar has serial numbers, and we inventory that on a daily basis, and we make those lists available on our website on a daily basis, and we inspect that physically twice a year, once at random. So I just wanted to add that point.
Great, thanks, Dan. So that question leads nicely into the next question, which is there counterparty risk with the ASI precious metal ETFs?
So I'll go ahead and take that one. The answer is no. We refer to our bullion funds as funds, but in fact they are actually trusts. Just as you would create a family trust for yourself for protective reasons, the fund is structured that way as well. And so there's essentially 3 parties that participate in this fund. Aberdeen Standard is obviously the advisor, and we are the one that launched the fund. We have a trustee who is Bank of New York Mellon, who oversees the trust and oversees that everything that's done in the trust is in the best interest of the shareholders. And then we have a custodian, as Steve mentioned, it's JP Morgan. Because of the trust structure, all of the bullion that is associated with any of our funds actually belongs to the trust. It doesn't belong to JP Morgan. It doesn't belong to Aberdeen Standard. It belongs to the trust itself. So that, to the extent that the trust ever needed to be liquidated for any reason, essentially the value of that trust would be nothing other than the value of that underlying bullion. And because it's a trust, no matter what happens to any of the parties involved, whether it's us, BNY Mellon, or JP Morgan, all of that bullion belongs to the trust, and again, would be valued and liquidated out to the shareholders of that trust.
And just one further comment, and it's unique a little bit too from an ETF perspective. There's a unique process in ETF called creation redemption process. And so the only folks that can create or redeem more shares are firms that we call authorized participants, typically big banks, liquidity providers, things along those lines. And it's important to note along the lines of what Stan had just indicated, when more shares are created, the AP has to deliver physical gold. It's not a situation where it's futures-based or any kind of other kind of, they have to deliver physical gold. If they don't have the ability to deliver physical gold, no new shares are created. And so the creation redemption process ensures that there is physical gold that's in the trust at all points in time from that standpoint. So for every creation unit, for every new shares that are created, those shares are backed by physical gold that is held within the trust. And along the lines of what Stan indicated, any type of change from a sponsor standpoint, any type of change that we would want to make to the actual trust, we have to get the approval of the trustee. In this situation, Bank of New York, since they serve as the trustee of the trust, they're working in what's in the best interest of the investors, not necessarily what's in the best interest of Aberdeen. And so those points are extremely important to make sure that folks understand and the security associated from a product perspective.
Great, thanks, Steve. And we have time for one last question. So Stan and Steve, are you finding that advisors are using precious metals as a more of a strategic or a tactical allocation tool?
Well, I'll start with that, and Steve, feel free to chime in. I think we've long been as product providers in this space since 2009. We've long been proponents of using precious metals as a diversifier in a portfolio context. I mean, as sort of as we go back to the slides that we had talked about today, the math is shown. If you add precious metals to a diversified portfolio, really in any amount, it can be a small amount, it can be up to 10% as we use in that example. It will have a positive impact on the risk-adjusted returns of that portfolio. So we've long been proponents of the strategic story, but as I indicated in that final slide, frankly, in my whole time being involved in commodities, which is almost 20 years now, I've actually never seen the stars align in such a way as they are now. For gold specifically, it's just it's an unfortunate situation in that obviously it's really, really good for gold, but when it's really, really good for gold, it's probably bad for all of us personally from a portfolio standpoint. But yeah, I've never seen the stars so aligned, and there's just so many things that are working in gold's favor right now. So I think there are a lot of tactical players that are trying to take advantage of that.
Yeah, and Adam, and I think one of the things that we didn't spend a lot of time talking about today is, we've talked a lot about the impact of diversification, and the interesting thing, even amongst the four precious metals, is there's actually low correlation amongst the four metals, right? And so what may be good for gold may not be good for platinum or palladium, which is sort of an interesting element. And certainly as you start to look at, once you get outside of gold and silver and start looking at things like platinum and palladium, they're much smaller marketplaces. They tend to have a little bit more volatility associated with them for a number of different factors, just not as many investors and things along those lines. So you do see that those products become a little bit used a little bit more tactically oriented. Like I said, there are investors out there who like to trade that volatility component. And even if you look at palladium, not just last year, but over the last 3 or 4 years, it's been one of the best performing assets that you could have had in your portfolio from that standpoint. And so it certainly would attract a little bit more of a tactical interest from that standpoint. And so that's not terribly surprising considering the size of the marketplace and like I said, some of the volatility associated. But I think Stan and I have been at the firm about the same amount of time, and I think we would both be, if you looked at something like our gold product, S-Gold, it is tremendously consistent in the way that it's utilized. And I would say a majority of the advisors that we work with that use that product use it in a very strategic manner. We don't see the same ebbs and flows that perhaps some of the other products out there that are used more from a trading vehicle standpoint. So I think our investors are attracted to the profile that we provide them, the cost associated with it, the fact that it's 10 plus years old at this point in time and has a track record. So you put a lot of those things together, it sort of reinforces it's a good strategic, it's a good product in a model portfolio and all those types of aspects. So it really does depend on the type of product, but certainly we see gold used much more strategically than we do tactically.
Great. Well, thank you for the answers. Chuck, yeah, there's no more questions at this time, so I'll hand it back over to you to close down the webinar.
Thank you, Adam. And I want to conclude by thanking everyone for attending our webinar this afternoon. If there's anything that we can do at iSectors to assist you with diversifying client portfolios, please let us know. We can be reached directly at 800-869-5184 or at the emails that are on your screen. Again, thank you, and we hope you have a safe and sound summer.